hope everyone had a fabulous Thanksgiving. Last week was actually pretty quiet for news because of the holiday and things like that. So this one will be a little shorter. But so the 5-year today is at 444. The 10-year is at 442. Rates seem to be staying below that 450 or that 4.5% level. So that said, Black Friday sales are expected to be less than spectacular. NerdWallet conducted a survey of consumers and found that 25% of all consumers still have credit card debt from last year's holiday season. 20% will apply for a credit card for this holiday season, and 1 in 3 people are forgoing presents entirely. 28% say they're going to spend less this year than they did last year. But sales are expected to be up 3 to 4% this year, still less than the 5.8% increase in 2022 and the whopping 13.2% increase in 2021 post-pandemic. It's really not the 3 to 4% range isn't really much less than the actual average increase of 3.7% from 2010 to 2019. But most of the increase in sales for this year is going to be a result of higher prices, right? Inflation, everything is getting more and more expensive. So the fact that consumers are only spending 3% more this year, pretty much taking into account inflation. So sales will be relatively flat when you compare it to inflation. We're going to be getting another core PCE reading this week. That's important. The consensus is 3.5%. And so for some perspective on this, we were at 5.5% this time last year. So we are making progress, even though no one seems to be focusing on that right now. Everybody's just really focusing on this 2% number and how we aren't hitting it yet. But monthly core PCE is the thing that matters the most, though. That jumped last month to 0.3%, which is at least partially what caused the treasuries to run up close to 5%. If it comes in at the expected 0.2%, that brings a 3-month average to 2.4%. Pretty darn close to the Fed's 2% goal. Now, treasuries have been hovering just under that 4.5% for the last few weeks, and that seems to be the new ceiling for now. We're also expecting to hear more tough talk from the Fed, which may put some upward pressure on treasuries. So whether we break through the 4.5% is likely dependent on Thursday's core PCE report. Now, treasuries have dropped 50 basis points, but I'm not seeing actual interest rates, like if you were going to get a multifamily loan, for example, or even a loan for a property you were going to buy for your business or a commercial property. We're not seeing those rates go down. Now, the conversation that anyways, like I said, we're not seeing like a 50 basis point drop in your rate. So if I was quoting you around 7 or 7.1 when the treasuries were close to 5, at or close to 5, it's not like rates are 6.5 or 6.6 today. In fact, I'm seeing rates higher than that. Now, when I'm talking to my lenders, I'm saying, what's the deal with this? And there's 2 things that are kind of happening right now. For one, a lot of banks are kind of like, this year's done. Let's just wait and see what happens next year. And some of it, a little bit of it, is because the treasuries have been super volatile. So our commercial lenders are not in the business of dropping rates and raising rates dramatically all the time. So if treasuries continue to hover around the 4.5% range, we're going to see some rates come down. It might not be until after the first of the year, though, because a lot of our lenders, like I said, they're kind of done with this year. So early next year, it's a new year. They're going to have new goals, and we might see actual rates going down the way they should, because truly in today's market, if we're just tying it to a margin over an index, rates should be somewhere in the neighborhood of like 6.75 to maybe even 6.5, depending. I will keep you posted on that. Keep watching in the coming weeks. I am definitely seeing some activity being sparked in the market, though. People trying to buy and make things happen in this market. It just takes a little bit for rates to drop, for people to try to get back off the sidelines and start buying. Now, overall, the market thinks that the Fed's done hiking rates and that they'll actually be cutting by May or June of 2024. But it's been a bumpy ride so far, so we can't completely rule out the possibility of another hike. As they say, we just have to watch the data. Now, a forecast from USC showed that high interest rates are hurting development, especially in areas with a major housing shortage like LA or even our great home of San Diego. The lower supply dips as we navigate the lack of financing and high rates, the lower inventory is going to drop, which will perpetuate the decreasing vacancy rates, increasing rents, and even less affordability for California residents as a whole. Now, that forecast says that 510,000 people left California between 2020 and 2022. Now, that number is a net of people leaving and people coming in. So it's 510,000 that left California. That is actually the size of the city of Atlanta, Georgia. It's a very strange factoid, but it just goes to show you how many people are actually leaving California. I don't know if it's an exodus, but it's certainly not a small number. Now, the affordable housing shortage is basically an indicator of what they call a region missing the mark for livability. So lack of inventory and a continued lull in development will result in California renters bearing the brunt of this situation. And it's going to give our brilliant politicians more ammo to justify all kinds of new regulation that's going to be costly for landlords, unless you start getting involved, that is. Now more than ever is crucial for landlords and people in the industry to get involved in local politics. The loudest noise is coming from unhappy tenants and the rising cost of rents, people getting kicked out of their apartments for renovations, and activist groups claiming to be the voice for tenants. So as landlords, we need to get involved and start talking to our politicians about the issues we struggle with, because it's not just tenants battling unaffordability. Landlords are seeing it too, with rising interest rates, insurance costs, the cost of materials and contractors, while pricing for properties have only adjusted modestly in comparison. If we don't voice our issues, we're at major risk of becoming LA or San Francisco. So over the coming months, I'm going to share more information about how you can get involved, because like I said, most of us landlords just want to do our business. We have no interest in getting involved in politics, but we really have no choice now. That is, if you want to stay in our beautiful state, if you want to continue investing in California, and you don't want to have so much red tape, you don't want to have rent control. I mean, we're already looking at having a transfer tax on the ballot that's actually worse than LA's new mansion tax. They're looking to strike AB 1482 and make the rules much more strict. It's very difficult to evict tenants now with the new tenant protection order. So already the ball is in motion. So if we don't get involved soon, I have to tell you, this is not the end of it. So like I said, I will keep you guys up to date in how you can get involved, how you can help, how you can speak and voice your concerns as a landlord, because they really need to hear it from us and they're not hearing it right now. So anyways, for coming up this week is just core PCE, and then we get a labor report next week. So I will report to you the results of core PCE and what the market is thinking for the labor report that's coming out next week. So we've got a couple weeks of important data coming out that may or may not affect treasuries depending on how the data comes in. You guys have a fabulous week. As always, if you have any questions, concerns, comments, anything, reach out to me. I'm always here.